So what is mark-to-market? Mark-to-market is actually something invented in 1993 and enhanced in 1997. With the internet, it's becoming much more known to taxpayers. Basically, it says that you will evaluate your stock at the end of the year, whether that's December 31st is your year or June 30th is your year, whichever years you have. At the end of the year, mark your stock as if you sold it. So if you have a stock and you bought, but you didn't sell on December 31st, 2021, if you have a mark-to-market put in place, the book and the brokerage firm treated you as if you sold it. So it depends on that day, what price the market give you. You could end up with a big income. The next day, the price will drop. Then you will be like, where is my income? But my taxes is here. So that's the danger of mark-to-market. I will elaborate that more, okay? And people are very scared of wash sales because they see that as a total loss. So let's give an example. On January 1st, 2021, you have an ABC stock, one stock for $10. You bought that $10. And March 1st come, 2021, ABC stock, one stock you have. And the value went down to 4. So you decided sell it. When you did that, what do you have right here? You created a $6 what? Loss. And in this case, because we are investor, right? Because we classify ourselves as an investor. And so this is my loss. It's a capital loss. If I stop right here, I file taxes. Then I have $6 capital loss. I can deduct because the maximum was $3,000. So I have $6 I can deduct. That $6 will offset your W-2, offset your other income just as normal. Now, but you are not just an investor, you are a little bit more involved. So on March 10th, and ABC stock start to come back, and you bought it back. At $7 per share, you bought it back. Now, because you bought it back within 30 days, okay, you created a wash sale loss right here. So you bought it back within 30 days, and you created a wash sale loss. How much? The loss you had between $10 and $4 is disallowed because you bought the same stock back within 30 days you sold it. So we have a $6 loss right here. So that $6 become your wash sale loss. And remember, when you look at your statement, there's a whole column of your wash sale losses that disallowed. That's because you actually bought it back, bought substantially the same stock back within 30 days. The loss is regarded as a wash sale loss. You cannot deduct this loss. So let's say now you're filing tax return. And you bought it back within 30 days. December come, you file tax return. So your statement would come out to say that wash sale lost $6. Can you deduct that? No, you cannot. So this will become, oh, well, I lost I didn't have any gain and didn't have any loss because I bought it back and loss was denied. Yes, that's correct. So that's where people are looking at the $6 and are feeling very sad. However, the $6 loss you were disallowed, that increased your stock basis. Remember you said you bought at $7. So your stock basis at March 10th, 2021 equals to what? Equals to this $7 plus the 6. So you got a $13 basis. What does base mean? Base means just that what you put in. What was your cost base? What was your 本钱? In Chinese, we call that 本钱, right? 你的本钱是什么东西, right? Now, let's say on December 31st, 2021, and you sold it. Sold one share for $20. So what is your capital gain, folks? Tell me. $20, you sold price minus your basis. So your capital gain is what? $7. Without wash sales, what would be your capital gain? Without wash sales, you would take the $20 minus 7 because that's what you bought for. So you would have capital gain of 13, but you only had capital gain of 7. So now when you file tax at the end of the year and your 1099B actually would have the wash sale denied 6, but also will tell you your capital gain is 7. So this is about our wash sales. So you see, someone was telling me that, oh, Ying, I don't want wash sales because they actually, I totally cannot deduct it. I lost it. You didn't lose it. You will recoup that when you sell that stock 100%. If you don't sell this stock, of course, you're not going to claim that $6 because it went into the base for you. But if you sold that stock empty, you just sold it, it will come out, save your taxes right here. And you actually did take advantage of that, just different timing. Okay. Now, let's talk about mark to market. So let's pretend I have the same stock. I am mark to market. So in this one, let me change my writing into red. So we're gonna do mark to market. So everything in red right now represents mark to market. Now, January the 1st, 2021. And mark to market, ABC one stock, $10, no problem. And March 1st went down to $4, I sold it. So what does that mean? In mark to market world, very simple. It is $10 minus $4. So you had a $6 loss. What loss? Is ordinary business loss. Then you will ask me, oh, what's the difference between the other loss you were saying right here, capital loss? The difference is in this mark-to-market world, this loss has no limitation. You don't have to limit that to $3,000 maximum. But if it is capital loss, like the blue one, you can, the most you can do is $3,000 per year to offset your income. So this one has no limitation, so it's ordinary loss. Then what happened on March 10th, and I bought it back? Nothing. So you bought it back. So your market value is $7. You bought it back. So you paid in $7. And let's say this is treated as a new transaction you just started in the mark-to-market world. So you basically, you put in $7. That's your market in. And you're not doing anything yet, so it's just gonna stay there. It is your put in, so it is not your income, it's not your loss, because it's almost like you know, it's your investment, right? It is your dollar put in, you're waiting to gain or to lose, right? So let's pretend on December 1st of 2021. Notice I didn't use the 31st date. I used the first date. And you sold ABC stock at $20, just like here. You sold for $20. And your ordinary gain would be what? What is your ordinary gain? Your ordinary gain would be the $20 minus what you put in. Remember, you put in $7 back in March, right? So your ordinary gain is $13. Assume you did not sell it on December 1st. And on December 31st, 2021, the stock went up to $50 a share. Remember, you did not sell. You were just holding for a better time to sell. So you arrived $50 per share. Regardless, you sell it or not, regardless. And mark to market means to treat this as if you sold. So what is your gain now? You don't have a choice but to wrap up your gain. So it is $50 minus $7. So $43 gain. Now I know what you're saying to me. You're like, what? I'm going to pay taxes on the $43? Yes, absolutely. No doubt. 100%. So that is the taxable income you will pay because the market indicated the stock went up to 50. And I tell people that I don't trade stock. Okay, I don't really, I'm not a stock trader. But I have many clients who are. Did you notice that on December 31st, most of the stock are raising their price? Did you notice that? They are actually going up on price. If you're mark to market, you are praising the market, paying more taxes. But of course, if they drop value, then you got losses, right? So mark to market just means that you have no control. It is marked to market price for you, regardless you sell it or not. Sure, in the process of the year, you buy and sell, buy and sell, buy and sell. So losses, gains are all listed over here. But on the last day of the year, God will decide what you make or what you lose. You have no control. So this is a mark to market. Now, I also know that you're going to ask me, oh, what happened? Okay, I paid $43 gain. What happened to my stock? Your stock is mark to market. So it will start at 50 on January the 1st of 2022. So you can sell, you can buy, and you get gain and loss and going on, right? So this is where I want you to kind of understand what is wash sales, what is mark to market. I think after you hear me talking right here, right now, you probably are thinking, Ying, I'm not sure that I should really elect the mark to market. Let me go further to talk about timing. mark to market is all about timing. And I want to mention to you about this. Mark to market is not a election to mark everything you have. You may have 5 brokerage account, but you can mark to market 1. You can mark to market 5. You can mark to market just 2. You don't have to market all of it. So that mark to market is really for day traders who are trading a lot. And then the more you trade, the lesser risk you have on December 31st, 2021, because the whole year fluctuation would ease the drop or the rise of stock price on the last day of the year. If you are not a day trader or you're not frequently trading, mark to market is really not something you should look at, because you could end up trading couple in the beginning of the year. Then at the end of the year, December 31st come, everything went up just for that day, and next day it goes down, and you don't trade every day, so you don't know the trend. Then you missed out the time to even rack up some losses, right? So it's really a decision. It's a business decision. It's a decision that your accountant probably not going to be capable to make for you. And it is really need you to be educated, understand my blueprints here and the red prints here. And so I would assume now you understand what is wash sales now, what is mark to market, what mark to market means.